Guys, hi. It's always good to be talking to you. Look, what I'd do is I thought I'd follow up on a couple of topics that were touched on in one of our lessons recently. And so the first one is loans and property devaluation. And look, I just want to work it through and just show you why deflation can be potentially damaging to an economy, particularly the banking sector. All right, so look, what I want us to do is look. Here's the start of a day. So you buy a house that's worth 100,000. Now remember, I'm keeping the numbers simple. I want you to be able to work them out in your head. So that's the market value. It's the purchase price, if you like. Now you've got 10% as a deposit, and so what it means is that to buy the house, you're going to have to go and ask the bank for a loan of $90,000. This is your deposit, or another way to think of that, that's your equity. Now, over the course of the day, what happens? Now, remember, we're modelling. Is that there's a 20% property devaluation. Now, that means that property, if you had to sell it at the end of the day, would only fetch you 80,000. But you've borrowed 90,000. And so when we do the sums to work out your equity, what we find is that you've got a negative equity. Up here, this is a positive equity. This one here is what we call a negative equity. Because if you sell the home, what you're going to get for that home is going to be 80,000, but you still have to pay back the bank their 90,000 they gave you. So you're going to have to find an extra 10,000 from somewhere, aren't you, to pay back the bank the 90,000. And so why would the bank want to be paid back that 90,000? Well, because the bank realises that it's made a bit of a balloon. It's lent you more money than what the asset is worth. So banks are required to manage themselves conservatively. Banks shouldn't really be taking gambles on whether property prices are going to go up. So you go from a negative equity to a positive equity situation. So their response is going to be to limit the damage, to limit the loss. And so what they're going to do is they're going to call in the mortgage, they're going to call in the loan, which effectively will, if you haven't got a lot of cash, and you won't have because that's the reason why you borrowed, then effectively you're going to be forced into selling that property. You'll get 80,000 for it, and then you'll have to find 10,000 to make sure that you pay back the bank. So if that is the case, then the bank has come out even Stevens, isn't it? So borrowed and lent at 90,000, and there was a repayment of 90,000. So the loss from the bank's point of view is zero. Now, if you can't find that extra 10,000, just haven't got it, then what's going to happen is that the bank's loss is going to be 10,000, isn't it? But what they've done is that they've limited the loss to 10,000. So what they've done is they've acted conservatively. And banks are always going to do that where there's a negative equity situation, unless somebody's got a lot of cash reserves or unless they're very, very asset rich. So is this forced sale thing happening in our economy right now? Well, yes, it is, with a lot of dairy farmers. A lot of dairy farmers are being, I won't say forced, but a lot of dairy farmers are realising, or some of them are realising, that they're going to have to sell their dairy farms because they're either in a negative equity situation or they are heading that way. And so you can see deflation from this point of view can be very destabilising, because what it does is it undermines the banking system. Why? Well, suddenly the banks have lent out more money than they should have. And so there are going to be questions about the liquidity of the banking system. All right, well, I hope that explains why deflation can threaten the stability of an economy, particularly if it's quite widespread, and particularly if the deflation is by a significant amount. Okay, I'll catch you later.